Robert Kiyosaki begins by saying that this book is not a book of quick tricks or stock market secrets. It is not about hot tips or guessing the next big company. Instead, it is a book about how rich people think before they invest. It is about the mindset, the principles, and the strategies that guide the wealthy. He explains that there are many books written for people who want to become rich, but very few that show how the rich actually invest. Rich Dad always said that investments are not found in the stock market first. They are found in the mind of the investor. If your mind is trained, opportunities appear everywhere. If your mind is untrained, even the best opportunity will look like a risk. Kiyosaki also shares that his poor dad believed in working hard, saving money, and depending on a job. But his rich dad believed in working smart, building assets, and creating money. This difference of thought is what made one dad struggle financially while the other dad became wealthy. The book is divided into 3 parts. Each part builds on the other, like steps on a ladder. First, we understand the investor and their mindset. Then, we learn how to choose what to invest in. Finally, we see what a real investor does to build long-term wealth. The journey begins with the first step. Before we can choose investments, we must first look at ourselves. We must ask, am I ready to be an investor? Do I know what kind of investor I want to become? That is where part 1 begins. Part 1, the investor and their investments. Before talking about money, Rich Dad always talked about the person who handles the money. He said that the success of an investment does not depend only on the stock market, the economy, or luck. It depends first on the investor. Who you are matters more than what you buy. Most people ask, where should I put my money? But Rich Dad believed that the better question is, who do I need to become in order to handle investments wisely? A person with fear, greed, or doubt will make poor decisions even with the best investment. But a person with knowledge, patience, and vision will create wealth even with small opportunities. This part of the book focuses on shaping the mindset of an investor. It is about preparing yourself mentally, emotionally, and strategically before jumping into the world of money. Rich Dad says that before choosing an investment, you must first choose the kind of investor you want to be. And that brings us to the very first question. A question most people never think deeply about. Chapter 1. What should I invest in? When people hear the word investing, their first question is usually the same. What should I invest in? Should I buy stocks? Should I put my money into real estate? Should I buy gold? Or maybe I should just save in the bank? This question seems natural, but Rich Dad used to smile and say, that is not the right first question. He explained that the real starting point is not the stock market, not a property listing, and not even a savings plan. The real starting point is the investor. You. He would say, an investment is only as good as the person who owns it. If you are not trained, even the best investment can turn into a loss. But if you are skilled, you can take an average deal and turn it into profit. The power lies not in the product, but in the mind of the investor. Robert Kiyosaki remembers how his poor dad always believed in finding safe investments. A house to live in, a job with a pension, money saved in the bank. But Rich Dad had a very different view. He said that nothing is truly safe or risky by itself. Risk comes from not knowing what you are doing. For someone who understands real estate, property can be one of the safest assets. For someone with no knowledge, the same property can be a disaster. Rich Dad once gave an example. Imagine 2 people looking at the same building for sale. One person sees only problems. The walls need repair, the area looks unattractive, and tenants might be difficult. They see risk. Another person looks at the same building and sees potential. Repairs could raise the value. The area is improving. Tenants will provide steady income. They see opportunity. The property did not change. The only difference was the eye of the investor. That is why Rich Dad always said, the first investment is not money. The first investment is in financial education. Learn the language of money. Learn how cash flow works. Learn how to analyze deals. Without this foundation, people are only gambling, hoping that luck will save them. He also explained that there is no universal answer to what should I invest in. Different people will take different paths. Some may succeed in business ownership. Some may do well in real estate. Others may choose paper assets like stocks or bonds. The key is to know yourself first. What are your goals? What skills do you want to build? What kind of risk can you handle? Once you understand that, the right investment path will become clearer. This is also why the rich seem to find opportunities that others cannot see. It is not luck, it is preparation. Their minds are trained to look for value where others see only problems. They think in terms of cash flow, control, and long-term growth. Because of that mindset, opportunities reveal themselves. So when you ask, what should I invest in? Rich Dad's answer is simple. Invest first in yourself. Once you strengthen your knowledge, your confidence, and your ability to control investments, you will naturally recognize the right opportunities for you. But Rich Dad also gave a warning. Knowledge alone will not be enough if your mind is weak. The market will rise and fall. Some investments will succeed, and others will fail. You will feel fear when money is on the line. You will feel greed when things go well. You will feel doubt when others criticize you. At those moments, what matters is not the investment itself, but your mental strength. And that brings us to the next step. Before deciding what to invest in, you must first ask yourself another critical question. Are you mentally prepared to be an investor? Chapter 2. Are you mentally prepared to be an investor? Before you can choose what to invest in, Rich Dad asked a critical question. Are you mentally prepared to be an investor? Many people believe that investing is all about money. They think that if they have enough cash, they can buy the right assets and wealth will follow. But Rich Dad taught that money alone is useless without the right mindset. He explained that investing is like riding a roller coaster. There will be highs and lows. The market will rise and fall. Some deals will succeed and others will fail. Without mental preparation, an investor will panic when things go wrong or make foolish decisions when things go right. Fear, greed, and doubt are the real enemies. Rich Dad emphasized 3 key qualities of a mentally prepared investor. The first is patience. Investing is not a game of instant wins. It is a long journey. Wealth builds slowly over time. Investors must learn to wait while their knowledge and assets grow. The second is discipline. A prepared investor follows a plan and does not act on emotions. They stick to strategies even when the world around them is chaotic. The third is curiosity. Investors must always ask questions, seek knowledge, and remain open to learning from every situation. Kiyosaki shares that his poor dad often let fear control his decisions. A drop in the stock market would create panic. A failed business opportunity would feel like disaster. Rich Dad, on the other hand, taught that every risk carries a lesson. Losses are not failures, but opportunities to learn. Every successful investor must develop the mental strength to embrace both gains and losses without being swayed by emotion. Another important point Rich Dad made is about decision-making under pressure. Most people make decisions based on anxiety, impatience, or peer pressure. The mentally prepared investor takes a step back, analyzes facts, and makes decisions calmly. This ability to remain clear-headed is more valuable than any insider tip or market forecast. He also discussed the need for confidence built on knowledge. True confidence is not blind optimism. It comes from understanding accounting, finance, and business principles. An investor who knows how money works will make smarter choices and take risks with control. Without knowledge, confidence is just arrogance, which often leads to losses. Rich Dad used a story of 2 young investors to illustrate this point. One had studied, practiced, and learned from mentors. The other had money, but no preparation. Both faced the same opportunity. The prepared investor saw possibilities and took calculated action. The unprepared investor hesitated and let fear dominate. The difference was mindset. Finally, mental preparation includes understanding your own strengths and weaknesses. Some investors are great at spotting opportunities, but poor at managing risk. Others are careful, but slow to act. Knowing yourself allows you to focus on areas where you excel and seek help where you are weak. In short, being mentally prepared is the foundation of all investing. Knowledge and strategy are useless if the investor cannot control emotions, remain patient, and think clearly. Once you have trained your mind, you are ready to move to the next step. The next chapter asks another essential question. What type of investor do you want to become? Because your mindset will guide your choices, but your vision will define the path you take. Chapter 3. What type of investor do you want to become? Once you are mentally prepared to be an investor, the next question is clear. What type of investor do you want to become? Many people never ask this. They jump into the market blindly, following tips or trends. But Rich Dad said that understanding the kind of investor you want to be is more important than picking your first stock or property. Kiyosaki explains that there are two broad categories of investors. The first are passive investors. They rely on others to manage their money. They invest in retirement funds, mutual funds, or other people's businesses. They hope that professionals will grow their money for them. The second type is active investors. They take control. They buy assets, manage businesses, and create systems that generate cash flow. They do not wait for opportunities to come. They create them. The choice between these two types is not about intelligence or education. It is about vision, ambition, and willingness to take responsibility. Passive investors may feel safer, but they also give up control. They rely on luck, market timing, and the decisions of others. Active investors accept risk, but they also gain freedom and financial power. Rich Dad also emphasized the importance of knowing your goals and values. Some people want security above all else. Others want freedom, influence, or legacy. The type of investor you become should align with your life goals. If you want freedom, you must learn to control investments. If you want security, your approach will be more cautious. But in every case, clarity about your goals makes every investment decision easier. Kiyosaki tells a story of his own journey. As a young man, he tried to follow his poor dad's advice. He looked for safe investments and steady jobs, but he felt trapped. When he listened to Rich Dad and decided to become an active investor, he started seeing the world differently. Opportunities appeared that he never noticed before. Risk no longer scared him because he was learning to manage it. Choosing your type of investor also involves understanding time commitment and energy. Active investing is not passive. It requires study, planning, and ongoing involvement. Passive investing requires patience and trust, but less hands-on effort. Knowing which path matches your personality and lifestyle is critical. Another key point Rich Dad made is about flexibility. Your type of investor may evolve over time. You may start passive while learning, then gradually become active. Or you may specialize in one kind of investment while delegating others. The important part is to make a conscious choice rather than drifting without direction. Finally, Rich Dad reminds that this choice sets the foundation for everything else. The way you think, the opportunities you seek, and the risks you take all depend on the type of investor you decide to become. This clarity gives focus, confidence, and purpose. Once you know your type of investor, the next step is about action. You must make a clear choice to commit to your path and begin building the skills and strategies needed to succeed. That brings us to the next chapter. The next lesson asks a crucial question: the choice. What will you do with your knowledge, mindset, and vision? The answer will define the rest of your investing journey. Chapter 4. The choice. After understanding your mindset and deciding what type of investor you want to become, the next step is simple but powerful: the choice. Every person must make it. Many people drift through life without realizing that investing is not just about money. It is about decisions. Every investment, every financial action begins with a choice. Rich Dad explained that most people make choices based on fear, comfort, or habit. They choose a safe job over starting a business. They choose to save in the bank instead of learning how to invest. They choose to follow the crowd rather than think independently. These choices may feel safe, but they also limit financial growth. The rich, on the other hand, make conscious choices. They choose to learn before they invest. They choose to take calculated risks. They choose to control their money rather than letting it control them. They choose action over passivity, knowledge over ignorance, and long-term vision over instant gratification. Kiyosaki recalls a story from his early life. He had a chance to invest in a small business, but fear held him back. His poor dad told him it was risky. His rich dad told him it was an opportunity to learn. The difference between regret and success was the choice he made. This story shows that investing is not about luck. It is about the choices you consciously make. Rich Dad also emphasized that making the right choice requires understanding your priorities. Are you investing for security, freedom, growth, or legacy? Each goal requires different strategies and different risks. Without knowing your purpose, even a good investment can feel wrong. Another lesson is that choices have consequences. A choice to avoid investing may feel safe today, but can create financial struggles in the future. A choice to invest wisely may feel uncomfortable at first, but can build wealth, independence, and opportunities for generations. Every choice carries both risk and reward. Rich Dad also talked about timing. Some people wait for the perfect moment to act. They wait for the market to stabilize, or for the economy to improve. The reality is that there is never a perfect moment. Mental preparation, knowledge, and courage are what create the right timing. Waiting for perfection often leads to missed opportunities. Finally, Rich Dad said that the choice is personal. No one else can make it for you. You cannot rely on advice alone. Friends, family, and experts may give opinions, but you must decide for yourself. The choice to invest, to learn, to grow financially, and to take control of your money is yours and yours alone. Once you make the choice, the next step is to understand the basics of investing. Knowledge without action is useless. Action without knowledge is risky. That is why the next chapter focuses on basics of investing, the principles that guide every successful investor. Chapter 5. Basics of Investing. Once you have made the choice to become an investor, Rich Dad said the next step is simple but crucial. You must learn the basics of investing. Without understanding the core principles, even the best opportunities can turn into mistakes. Investing is not a gamble. It is a disciplined practice built on knowledge, strategy, and control. Rich Dad taught that the foundation of all investing is understanding the difference between assets and liabilities. An asset is something that puts money in your pocket. A liability is something that takes money out. Most people think owning a house or a car is an asset. But if it costs more to maintain than it earns, it is a liability. Wealth grows when assets increase, not when liabilities multiply. Another basic principle is cash flow over capital gains. Many people focus only on buying things that will increase in value. Rich Dad said this is risky. What matters most is the income an investment generates regularly. Cash flow creates security, stability, and the ability to reinvest. The price of an asset may fluctuate, but cash flow continues to build wealth over time. Kiyosaki also emphasizes control. Investing is not about hoping that something will work out. It is about taking control of the assets you own. Control can mean managing a business, choosing tenants for real estate, or learning the rules of a stock investment. The more control you have, the safer your investment becomes, because you are not dependent on luck or external factors. Another fundamental lesson is understanding risk. Risk is often misunderstood. Many people believe that investing itself is risky. Rich Dad said the real risk comes from ignorance. The more you know about an investment, the less risky it becomes. Risk is not something to fear. It is something to manage through knowledge and preparation. Rich Dad also explained diversification wisely. Many investors diversify blindly, spreading money thin across unrelated assets. This can reduce potential gains. Instead, he suggested understanding your investments thoroughly and diversifying in areas you can control and understand. Knowledge and focus are better than random diversification. Additionally, every investor must learn the principle of reinvesting. Profits should rarely be spent immediately. They should be used to acquire more assets, generate more cash flow, and increase financial strength. This is how small investments grow into real wealth over time. Finally, the basics of investing are not about numbers alone. They are about mindset. Patience, discipline, and continuous learning form the backbone of every successful investor. Rich Dad said that if you master these basics, everything else, stocks, bonds, real estate, businesses, becomes easier. You will recognize opportunities, manage risk, and grow your wealth consistently. Once you understand these core principles, the next question naturally arises. Where exactly can you apply them? What types of investments should you consider? That is the focus of the next chapter, Different Investment Choices, where we explore options and how to match them to your skills, goals, and type of investor. Chapter 6, Different Investment Choices. After learning the basics of investing, the next step is understanding different investment choices. Rich Dad emphasized that knowledge alone is not enough. You must also know where to put your money and how each option works. Not every investment is suitable for every investor. Your skills, goals, and type of investor determine what works best for you. Kiyosaki explains that investments can be broadly divided into 5 main categories. The first is business ownership. Owning a business allows you to create systems, hire others to work for you, and generate cash flow. A successful business can grow exponentially, but it requires effort, vision, and management skills. Many rich people build wealth primarily through businesses because they control operations and profits. The second category is real estate. Real estate can provide steady income through rent, tax advantages, and long-term appreciation. But it also requires knowledge of markets, property management, and financing. Rich Dad taught that the right property in the right location, managed effectively, can be one of the safest and most profitable investments. The third category is paper assets, such as stocks, bonds, and mutual funds. These are often the first things people think of when they hear investing. Stocks can grow in value and provide dividends. Bonds can offer steady interest income. The key is to understand the company, industry, and risk involved. Blindly buying stocks without research is gambling, not investing. The fourth category is commodities and precious metals like gold, silver, and oil. These assets often protect against inflation and can diversify a portfolio. However, they do not usually produce cash flow. Their value depends on market trends and global events. Rich Dad suggested using them strategically, not as the foundation of wealth. The fifth category is paper and intellectual assets, which include royalties, patents, or other forms of intellectual property. These assets can create ongoing income and often require creativity, knowledge, or innovation to develop. Rich Dad highlighted that inventing or owning unique ideas is a way the wealthy expand their influence and cash flow. Kiyosaki also stressed that choosing the right investment requires matching it to your type of investor. A passive investor may prefer stocks and mutual funds, while an active investor may focus on businesses and real estate where they can control outcomes. Personal strengths, knowledge, and interests should guide every decision. Another important lesson is risk management. No investment is completely safe. The key is to understand each investment's risks and learn how to protect your capital. Research, preparation, and continuous learning reduce risk and increase the chances of success. Finally, Rich Dad reminded that investments are not just about money. They are about opportunity, control, and creativity. The richest people often find unconventional investments that others overlook. They see potential in ideas, properties, or businesses that most people ignore. Your role as an investor is to train your mind to see these opportunities and take action. Once you understand the different investment choices, the next step is learning how to reduce risk and make informed decisions. That leads naturally into part 2, where we explore how investors choose what to invest in and how knowledge transforms risk into opportunity. Part 2. The investor chooses what to invest in. Part 1 focused on the investor, their mindset, preparation, and understanding the basics and options for investing. But knowing the possibilities is only half the journey. Part 2 is about making choices wisely. It is about turning knowledge into action while managing risk. Rich Dad always said that investing without understanding risk is like driving in the dark. You may move fast, but you cannot see what is ahead. The rich do not avoid risk. They manage it. They educate themselves, analyze opportunities, and make decisions from a position of knowledge rather than fear or luck. In this part, Kiyosaki explains how to reduce risk through financial education, how to see the world like an investor, and how to develop a personal plan. These lessons teach that the right mindset alone is not enough. You must pair it with knowledge, strategy, and awareness. The journey begins with the first principle of Part 2, understanding that risk is not the enemy, ignorance is. And that is where the next chapter begins. Reduce risk through financial education. Chapter 7. Reduce risk through financial education. Rich Dad always said that risk is not something to fear. The real danger in investing is ignorance. Many people believe that investing is risky because markets rise and fall, or because businesses fail. But the truth is, risk comes from not knowing what you are doing. Knowledge transforms risk into opportunity. That is why financial education is the first tool of every successful investor. Kiyosaki explains that the more you understand about money, assets, and markets, the more control you have over your investments. Education allows you to see the difference between fear and real risk. Without knowledge, even a small investment can feel overwhelming. With knowledge, even a challenging investment can become manageable. Financial education is not just about reading books or taking courses. It is about learning by doing, observing patterns, and understanding the flow of money. Rich Dad encouraged learning about accounting, taxation, business structures, and cash flow. Each of these areas gives the investor a map of the financial world, helping them make smarter choices and avoid common mistakes. Another lesson Rich Dad emphasized is understanding the rules of the game. Many investors fail because they do not know the laws, regulations, or strategies that govern money. The more you know, the more leverage you have. Knowledge allows you to protect your wealth, maximize profits, and reduce losses. Ignorance, on the other hand, leaves you vulnerable to mistakes, scams, and unforeseen problems. Kiyosaki shares that investors who continuously educate themselves are able to see opportunities that others miss. While most people see a market downturn as a danger, a financially educated investor sees it as a chance to buy undervalued assets. While others panic, they analyze, calculate, and act with confidence. Financial education also teaches you to question assumptions. Many people invest because someone told them it was safe or profitable. A knowledgeable investor does not blindly follow advice. They research, compare options, and make decisions based on facts and understanding. This habit reduces emotional decision-making and prevents costly mistakes. Rich Dad also highlighted that reducing risk is a continuous process. Markets change, new industries emerge, and laws evolve. An investor must stay updated, constantly learning and adapting to maintain control. Complacency is a hidden form of risk, because yesterday's knowledge may not solve tomorrow's challenges. Finally, Kiyosaki stresses that financial education gives you confidence and independence. You no longer rely entirely on financial advisors, friends, or trends. You understand the principles behind your investments. You can make choices deliberately rather than reacting to fear or hype. This mindset separates wealthy investors from the majority. Once you understand how education reduces risk, the next step is learning from experience. Rich Dad often said, "Investing lessons begin not in a classroom, but in the real world." Observing, analyzing, and reflecting on investments is where theory turns into practical skill. That is the focus of the next chapter. My Investor Lessons Begin. Chapter 8. My Investor Lessons Begin. After learning that knowledge reduces risk, Rich Dad encouraged Robert to begin experiencing investing in the real world. Education is powerful, but theory alone cannot make you a successful investor. True learning happens when you start applying lessons, observing results, and refining your strategies. That is when investor lessons truly begin. Kiyosaki recalls his first steps into investing. He started small, with manageable risks, always observing carefully. Each experience, whether a success or a mistake, became a lesson. Rich Dad emphasized that every investment carries information. If you succeed, you learn what works. If you fail, you learn what does not. Both outcomes are equally valuable if you pay attention. One of the first lessons Robert learned was the importance of observation. Investors must watch markets, businesses, and trends carefully. Most people ignore details or assume outcomes will be like yesterday. The prepared investor notices small changes, understands patterns, and anticipates opportunities. Observing how money moves is just as important as knowing where to place it. Another key lesson was action paired with reflection. Many beginners overthink or hesitate. They read endlessly, waiting for perfect conditions. Rich Dad taught that you must act with what you know, then analyze the results. Reflection turns mistakes into experience and experience into wisdom. Without action, knowledge remains unused. Kiyosaki also realized the value of mentorship and guidance. Rich Dad often guided him through decisions, asking questions instead of giving answers. This approach forced him to think critically, weigh risks, and understand consequences. Mentors do not simply provide instructions, they teach you how to think like an investor. He learned that emotional control is critical. The first few investments tested patience and fear. Markets fluctuate, profits rise and fall, and uncertainty is constant. Many novices react emotionally, selling too soon or holding too long. Rich Dad taught that controlling emotions is as important as understanding numbers. Calm decisions create consistent results over time. Another lesson was matching investments to personal strengths. Robert noticed that not all opportunities suited him. Some required skills he did not yet have. He learned to focus on investments where he could add value, control outcomes, and leverage knowledge. Understanding your strengths reduces risk and increases potential gains. Finally, Robert learned that investing is a lifelong process. No single deal guarantees wealth. Each lesson builds on the previous one. Learning to evaluate, act, and reflect becomes a habit. Over time, these habits compound, just like money, creating both financial and personal growth. Once you begin learning through action, the next insight emerges naturally. It is not just about making money. It is about understanding the world you see as an investor. Your perspective determines what you recognize as an opportunity and what you avoid as a risk. That is the focus of the next chapter. What kind of world do you see? Chapter 9. What kind of world do you see? One of the most important lessons Robert learned from Rich Dad is that the world you see shapes the investments you make. Two people can look at the same opportunity and see completely different outcomes. One sees risk, the other sees potential. One sees a problem, the other sees a chance to create value. The difference is perspective. Rich Dad often said that your mindset filters reality. If you see the world as dangerous and unstable, every investment will feel risky. You will hesitate, miss opportunities, or avoid taking action altogether. If you see the world as full of possibilities and learn how to manage risk, opportunities appear everywhere. Investors train themselves to look beyond fear and focus on potential. Kiyosaki recalls an example of a small building for sale. Many people ignored it because it looked old, the area seemed unsafe, and the repairs looked expensive. To most, it was a risk waiting to happen. But Robert, guided by Rich Dad's lessons, saw something different. He noticed the neighborhood growing, the possibility to improve the property, and the potential rental income. The building became an investment because he saw it differently than others. Another key lesson is that seeing the world as an investor requires imagination and analysis together. Imagination allows you to envision what could be. Analysis ensures that your vision is grounded in facts and numbers. Investors who combine both skills can identify opportunities that most people overlook. Without imagination, you may miss potential. Without analysis, you may take unnecessary risk. Rich Dad also taught that your worldview affects your tolerance for uncertainty. If you see change as dangerous, you will resist new ventures. If you see change as opportunity, you embrace innovation and growth. Markets, technologies, and economies are always evolving. The investor's perspective must evolve too, allowing them to adapt, innovate, and profit. Kiyosaki explains that financial education helps you see the world differently. Knowledge sharpens your lens. Understanding assets, cash flow, and market principles transforms fear into clarity. What once seemed like risk now becomes manageable, because you know the rules, the risks, and the strategies to control outcomes. Another insight is that your worldview is shaped by experience and mentorship. Rich Dad encouraged Robert to see opportunities where others saw obstacles. Observing successful investors, learning from mistakes, and reflecting on outcomes changed the way he approached the world. Over time, perspective becomes a skill as powerful as any technical knowledge. Finally, seeing the world differently is not just about spotting opportunities. It also affects how you handle failure. An investor who sees setbacks as lessons, not disasters, can recover faster, adjust strategies, and grow stronger. Perspective shapes decisions, actions, and ultimately, success. Once you learn to see the world through an investor's eyes, you begin to understand why investing is not inherently risky. Risk exists only for those who lack knowledge, preparation, and vision. That lesson leads directly into the next chapter: Why Investing Isn't Risky. Chapter 10. Why Investing Isn't Risky. Many people believe that investing is risky. They think that the stock market, real estate, or starting a business is dangerous. But Rich Dad had a different perspective. He said that investing itself is not risky. What is risky is not understanding what you are doing. Knowledge, preparation, and strategy turn apparent risk into opportunity. Kiyosaki explains that fear often clouds judgment. When people see prices fall, they panic. When markets fluctuate, they hesitate. When opportunities seem unfamiliar, they avoid action. Fear creates risk, not the investment itself. The financially educated investor sees risk as a problem to solve, not a threat to escape. Rich Dad taught that the key to safe investing is financial intelligence. This means understanding cash flow, assets versus liabilities, and how money works. When you know how an investment generates income, what factors affect its value, and how to protect your capital, the investment becomes far less risky. Ignorance, not the market, is what creates danger. Another lesson is control. Investments that allow you to control decisions are far safer than those where you have no say. Owning a business, managing rental properties, or having influence over financial decisions reduces risk. Investors who control their assets can act to protect themselves. Those who surrender control rely on luck, which is never reliable. Kiyosaki also points out the importance of due diligence and research. An educated investor studies opportunities thoroughly. They analyze numbers, trends, and projections. They seek advice from mentors and learn from others' mistakes. Each decision is deliberate, reducing the chance of unexpected losses. Preparation and insight are more powerful than luck. Rich Dad emphasized that risk is personal, not universal. What is risky for one person may be safe for another. For someone with knowledge, cash flow, and control, a business may be a steady income source. For someone unprepared, the same business may fail. Understanding yourself, your strengths, and your limits allows you to navigate risk effectively. He also discussed perception of time and opportunity. Many people avoid investing because they fear short-term losses. But long-term thinking changes everything. The patient investor looks beyond temporary fluctuations and focuses on consistent growth and cash flow. Understanding the long game turns apparent volatility into opportunity. Finally, Rich Dad said that the mentally prepared and financially educated investor sees investing as a tool, not a gamble. Investments are opportunities to create value, generate income, and build wealth over time. The difference between success and failure is knowledge, preparation, and perspective, not luck. Once you understand why investing is not inherently risky, the next question naturally arises. On which side of the table do you sit? Are you creating wealth, or are you dependent on others' decisions? That lesson is explored in the next chapter. On which side of the table do you sit? Chapter 11. On which side of the table do you sit? Rich Dad often asked Robert a simple but profound question. On which side of the table do you sit? Most people never think about this. They work for money, pay taxes, and follow rules without realizing that their position determines their financial outcomes. Knowing your side is critical to building wealth. Kiyosaki explains that there are essentially two sides of the table in every financial situation. The first is the employee or consumer side. People on this side exchange time for money. They earn a salary, pay bills, and rely on external systems to provide income. They face taxes, debt, and financial pressure. While this side can provide security, it rarely creates real wealth or financial freedom. The second side is the investor or business owner side. People on this side use money and assets to generate income. They create businesses, invest in real estate, buy stocks, and control cash flow. They leverage systems, people, and capital to work for them. This side offers independence, wealth growth, and freedom, but it requires knowledge, discipline, and courage. Rich Dad explained that most people spend their lives on the wrong side without realizing it. They follow conventional advice. Get a degree, find a stable job, save money, and retire comfortably. While there is nothing wrong with this path, it limits financial potential. Wealth grows exponentially for those who sit on the investor side. Kiyosaki learned that understanding your side of the table changes how you approach money. On the employee side, the focus is often on job security, benefits, and paychecks. On the investor side, the focus shifts to cash flow, asset management, and long-term strategy. The same dollars, viewed from different sides, have entirely different power and potential. Another key lesson is the transition between sides. Many people start as employees or consumers. The financially successful ones learn to move to the investor side gradually. They start small, acquire knowledge, gain control, and take calculated risks. Over time, they build enough assets and cash flow to make the shift permanent. Rich Dad also emphasized the mindset difference. Employees often see money as limited and opportunities as scarce. Investors see money as a tool and opportunities as abundant. This mental shift allows investors to create wealth instead of being constrained by circumstances. Finally, Kiyosaki stresses that your side of the table affects your decision-making, risk tolerance, and opportunities. Sitting on the right side allows you to control your future, leverage knowledge, and use money strategically. Sitting on the wrong side leaves you dependent on others, vulnerable to risk, and limited in growth. Once you understand your position, the next step is to learn the basic rules of investing that guide successful decisions. This is the focus of the next chapter. Basic Rules of Investing. Chapter 12. Basic Rules of Investing. After understanding which side of the table you sit on, Rich Dad taught Robert that every investor must follow basic rules of investing. These rules are simple but powerful. They guide decisions, reduce risk, and help money work for you. Ignoring them can lead to mistakes, losses, or missed opportunities. The first rule is never lose money. This does not mean avoiding all risk, but protecting your capital is essential. Every investment should have a margin of safety. Knowledge, research, and preparation reduce the chances of loss. Investors who follow this rule survive market fluctuations, mistakes, and unexpected challenges. The second rule is learn before you invest. Rich Dad stressed that money alone does not create wealth. Knowledge creates wealth. Understanding assets, cash flow, market dynamics, and financial statements ensures that every decision is informed. Education reduces fear, increases control, and turns potential risk into opportunity. Another critical rule is invest for cash flow, not just appreciation. Many people focus on assets that may increase in value, like stocks or real estate. But the truly wealthy focus on income generation. Cash flow allows reinvestment, creates financial freedom, and provides stability even if market prices fluctuate. Rich Dad also emphasized control over your investments. Owning assets without control is dangerous. Whether it is a business, rental property, or partnership, control allows you to manage risks, make decisions, and maximize returns. Lack of control leaves you dependent on others. increasing uncertainty and vulnerability. Another rule is diversify intelligently. Many beginners spread money too thin or invest randomly. Smart investors focus on a few areas where they understand the market and can add value. Diversification is about reducing unnecessary risk, not diluting knowledge and effort. Concentrated, well-understood investments often outperform scattered ones. Kiyosaki learned another lesson. Invest regularly and reinvest profits. Wealth does not grow from one big win. It grows from repeated, disciplined investing. Using profits to acquire more assets compounds wealth over time. Patience and consistency are more powerful than chasing quick gains. Finally, Rich Dad stressed thinking long-term. Markets and economies fluctuate. Opportunities come and go. Short-term thinking often leads to emotional decisions, panic selling, or missed potential. A long-term perspective allows investors to ride out volatility, focus on cash flow, and achieve true financial growth. These basic rules form the foundation for every investment decision. They guide mindset, strategy, and action. Once you understand them, the next step is taking control of your money and your investments. That lesson is explored in the next chapter. Investing means taking control. Chapter 13. Investing means taking control. Rich Dad often reminded Robert that investing is not a spectator sport. You cannot simply give money to someone else and hope for the best. To succeed, you must take control of your investments, decisions, and financial future. Control is the difference between creating wealth and being dependent on luck or others' choices. Kiyosaki explains that many people avoid responsibility because they fear making mistakes. They rely on financial advisors, brokers, or managers without understanding the investments themselves. This approach may seem safe, but it is risky. When you give away control, you also give away the power to protect, grow, or adjust your assets. Taking control begins with understanding your investments fully. Whether it is real estate, stocks, a business, or intellectual property, you must know how it works, how it generates income, and what factors affect its value. Knowledge allows you to make informed decisions rather than reacting blindly to market movements or advice from others. Another key principle is active involvement. Passive investors may monitor portfolios occasionally, but active investors consistently engage. They track performance, analyze trends, and adjust strategies when necessary. Even small actions, like renegotiating a lease or improving a business process, can dramatically increase returns. Control creates opportunities that passive approaches cannot. Rich Dad also emphasized the importance of financial self-education. Control does not come from delegating knowledge. It comes from developing it yourself. Learning accounting, tax strategies, and market dynamics allows you to make confident decisions. The more control you have over your understanding, the less dependent you are on others, and the safer your investments become. Kiyosaki recalls a personal lesson. Early in his journey, he invested in a small business without full control. The venture underperformed because he relied too heavily on others' judgment. Later, by taking active control, learning management, and monitoring operations, he transformed similar businesses into profitable ventures. Experience taught him that control is as important as capital. Another insight is risk management through control. When you are in charge, you can take proactive steps to minimize losses, protect assets, and optimize returns. Control does not eliminate risk, but it turns unpredictable outcomes into manageable situations. It transforms fear into strategy. Finally, Rich Dad emphasized that taking control is not about micromanaging every detail. It is about understanding key levers: cash flow, expenses, growth potential, and strategic decisions, and guiding them effectively. Control allows you to shape the future of your investments rather than being shaped by circumstances or the actions of others. Once you understand the importance of control, the next lesson focuses on the two types of investors. Rich Dad explained that recognizing your style, strengths, and approach allows you to invest more effectively and align actions with goals. This is the focus of the next chapter. Two types of investors. Chapter 14. Two types of investors. Rich Dad explained that not all investors approach the market the same way. He divided investors into two main types: the active investor and the passive investor. Understanding which type you are, or which type you want to become, is critical to building wealth and making informed decisions. The active investor is hands-on. They control their investments, analyze opportunities carefully, and take an active role in management. This type of investor may own businesses, manage rental properties, or actively trade in stocks while tracking market movements. Active investors take responsibility for outcomes and are deeply involved in decision-making. Their success depends on knowledge, skill, and effort. The passive investor, on the other hand, takes a hands-off approach. They may invest in mutual funds, index funds, or other vehicles that are managed by others. Passive investors rely on the expertise of professionals and generally do not make frequent decisions about their assets. This approach is less time-consuming, but often offers slower growth and less control. Kiyosaki emphasizes that neither type is inherently better. Each has advantages and disadvantages. Active investors can achieve higher returns, but their involvement requires more time, effort, and responsibility. Mistakes can be costly if they act without proper knowledge. Passive investors have lower stress and less direct responsibility, but they may miss opportunities and cannot fully control outcomes. Rich Dad also highlighted that investor type affects mindset and behavior. Active investors continuously seek knowledge, monitor performance, and adapt to changing markets. They see opportunities and challenges and take calculated risks. Passive investors focus on stability and consistency, often preferring long-term, less volatile returns. Both approaches require discipline, but the mindset and strategies differ. Another important lesson is that investor type can evolve. Many start as passive investors to learn and gain confidence. Over time, some transition to active investing once they acquire knowledge, experience, and financial capacity. Others may choose to remain passive, focusing on stability and long-term growth. The key is aligning your approach with your skills, goals, and risk tolerance. Kiyosaki also explains that understanding your investor type helps in choosing the right opportunities. Active investors may seek businesses, real estate, or startups where they can make decisions. Passive investors may focus on funds, dividend stocks, or long-term assets that require minimal involvement. Knowing your type prevents mistakes and reduces stress, allowing you to invest effectively. Finally, Rich Dad stressed that both types require continuous learning. Markets, regulations, and opportunities change over time. Whether you are active or passive, staying informed, analyzing options, and refining strategies is essential. Education and experience are what transform both types into successful investors. Once you understand the two types of investors, the next step is to develop your own investor plan. Knowing your type is just the beginning. Creating a structured plan aligns your choices, actions, and goals. That is the focus of the next chapter: developing your own investor plan. Chapter 15: Developing your own investor plan. After learning about the types of investors, Rich Dad emphasized that knowledge alone is not enough. Every investor must have a personal plan. An investor plan is a roadmap that outlines goals, strategies, risk management, and action steps. Without a plan, even the most educated investor can drift, make mistakes, or miss opportunities. Kiyosaki explains that a strong investor plan begins with clarity about your financial goals. What do you want to achieve? Are you looking for cash flow, long-term growth, or financial freedom? Goals define the type of investments you pursue, the level of involvement required, and how much risk is acceptable. Clear goals also motivate action and provide a benchmark for measuring success. The next step is assessing your resources and strengths. This includes money, skills, knowledge, and time. Every investor has limits and advantages. An effective plan matches investments to strengths and compensates for weaknesses. For example, if you have experience in real estate, that may be a focus. If you prefer hands-off approaches, funds or managed businesses may suit you better. Risk management is a core component of any investor plan. Rich Dad taught that every plan must include strategies to protect capital. This could involve diversification, insurance, due diligence, or contingency planning. Knowing how to respond to setbacks or market changes ensures that risk does not derail your journey. Another key element is education and continuous improvement. A plan is not static. It evolves as you gain experience, learn new strategies, and adapt to changing markets. The rich continuously refine their plans, always seeking better opportunities and ways to optimize results. Education transforms experience into wisdom and keeps the plan effective over time. Kiyosaki also stresses the importance of action steps and timelines. A plan must move beyond ideas into concrete actions. This includes identifying investments, allocating funds, and setting milestones. Goals without actions remain dreams. A disciplined approach ensures consistent progress and builds momentum. Finally, Rich Dad explained that developing your own plan prepares you for the next stage of investing. Not just making money, but thinking and acting like the rich. Once you have a plan, the focus shifts from managing small investments to creating larger opportunities, understanding taxes, corporations, and financial leverage. It is about moving from being a good investor to becoming a real investor. This chapter naturally connects to Part 3, where Kiyosaki explores the mindset, strategies, and habits of the real investor. Part 3 focuses on how the wealthy think differently, use money strategically, and create wealth that grows independently of active effort. The lessons here set the stage for understanding the philosophy behind becoming a true investor, which begins with the principle that the rich don't work for money. Part 3, The Real Investor. Part 1 and Part 2 focused on understanding the investor, the mindset, and how to make informed choices. Part 3 shifts to the real investor, those who think, act, and see the world differently. These investors do not just follow rules, they create wealth, influence systems, and use money strategically. Rich Dad always said that the wealthy do not work for money, and they do not rely solely on saving or luck. They understand how money works, how to create it, and how to make it grow independently. Part 3 explores these principles in depth. In this section, Kiyosaki examines how the rich think differently, manage risk intelligently, and use financial knowledge to gain control. You will learn why traditional approaches like working for a paycheck or saving alone do not build lasting wealth. Instead, the real investor focuses on creating assets, leveraging systems, and thinking strategically. The journey begins with the first principle of Part 3, understanding why the rich don't work for money and how this mindset sets them apart from everyone else. This is the focus of the next chapter. Chapter 16. The Rich Don't Work for Money. Rich Dad often told Robert a lesson that challenged everything he had been taught in school. The rich do not work for money. Most people work hard, earn a paycheck, and trade time for money. They hope that saving, promotions, or job security will bring wealth. But the rich understand that money is a tool, not a goal. Kiyosaki explains that working for money keeps people trapped in a cycle of dependency. You earn, spend, pay taxes, and repeat. Your income depends on your effort, your hours, and your employer. This is the foundation of the employee mindset, and it rarely leads to financial freedom. The rich break free by making money work for them. Rich Dad's lesson is that the rich focus on creating assets. These are things that generate cash flow independently of their personal effort. Businesses, real estate, intellectual property, and investments all create income, while the investor does not actively work every hour. Money becomes a servant, not a master. Another key point is understanding opportunities versus fear. Most people avoid investment opportunities because they fear losing money. The rich see opportunity and take calculated risks. They understand the difference between working for money and using money to create more money. The mindset shift is profound. You stop chasing money and start creating systems that generate wealth. Kiyosaki also highlights the importance of financial education in breaking free from the paycheck trap. Without knowledge, it is easy to remain dependent on a job. Learning about assets, liabilities, and cash flow gives control. Once you understand how money works, you can redirect it toward building income-generating assets rather than just earning a salary. Rich Dad encouraged Robert to look beyond conventional measures of success. High-paying jobs, titles, and degrees do not guarantee wealth. True financial independence comes from ownership and control. The rich focus on what they own, how it generates income, and how they can grow it, instead of relying solely on their labor. Another lesson is that the rich embrace calculated risk and innovation. While others work to minimize uncertainty, the wealthy use knowledge, skill, and strategy to take informed action. They understand that fear and comfort are enemies of financial growth. By using money strategically, they transform risk into opportunity. Finally, Kiyosaki explains that adopting this mindset is the first step to becoming a real investor. It is not about working harder. It is about thinking differently, creating assets, and letting money work for you. Once you understand this principle, the next lesson naturally follows. Why the rich don't save money in the traditional sense, and how saving alone cannot build wealth. Chapter 17. The rich don't save money. Rich Dad taught a lesson that surprised many. The rich don't save money in the conventional sense. While most people believe that saving is the foundation of wealth, the wealthy understand that money sitting in a bank or under a mattress does little to create true financial freedom. Money must work to grow. Kiyosaki explains that saving without investing often leads to slow growth and vulnerability. Inflation, taxes, and opportunity cost erode the value of saved money. The rich understand that holding cash is not wealth. It is temporary security. Real wealth comes from directing money into assets that generate income and appreciate over time. Rich Dad encouraged a different approach. Allocate, invest, and multiply. Instead of saving for safety, the wealthy focus on acquiring assets, businesses, real estate, stocks, or intellectual property that produce cash flow. Each dollar invested is a worker that generates more money, allowing wealth to compound rather than stagnate. Another lesson is managing expenses wisely. The rich do not live extravagantly by default. They prioritize investment over consumption. While employees may spend paychecks on liabilities, the wealthy use income to buy assets that generate more income. This shift in mindset separates those who accumulate debt from those who accumulate wealth. Kiyosaki also highlights the role of financial education in making money work. Knowing which investments generate reliable returns, understanding market cycles, and recognizing opportunities reduces fear and allows money to grow confidently. Ignorance, on the other hand, makes people hoard cash, miss opportunities, or take unnecessary risks. Rich Dad often reminded Robert that risk is minimized when money is educated. The wealthy do not avoid spending or investing. They control and direct money intelligently. By learning the rules of investment, managing cash flow, and leveraging assets, money grows while creating additional security. Saving alone cannot achieve this. Finally, Kiyosaki emphasizes that understanding why the rich don't save sets the stage for the next lesson: acting on behalf of others to learn financial principles. Many lessons in investing and wealth creation are easier to grasp when experienced through guidance and mentorship. This leads directly into Chapter 18, On Behalf of Rich Dad's Son, where Robert shares how observing and participating in his rich dad's investments taught him invaluable lessons. Chapter 18, On Behalf of Rich Dad's Son. Rich Dad believed in learning by doing, but he also understood the value of mentorship and observation. One of Robert's most powerful lessons came from participating in investments on behalf of his rich dad's son. This approach allowed him to experience real-world financial decisions while being guided by wisdom and strategy. Kiyosaki explains that Rich Dad never simply gave instructions. He created situations where Robert could act, make decisions, and observe outcomes. Sometimes he succeeded, sometimes he failed, but every experience was a lesson. This hands-on approach accelerated learning far beyond traditional education. One key principle is responsibility without full risk. By acting on behalf of his son, Robert could test ideas, analyze opportunities, and see consequences in a controlled environment. It was a safe, yet real experience. The rich understand that financial education is more than theory. It requires trial, reflection, and correction. Another lesson was seeing opportunities others overlook. Rich Dad often presented investments that seemed unappealing at first glance. Many people ignored these deals because they feared complexity, risk, or the unknown. Robert learned to evaluate each opportunity carefully, identify potential, and calculate risks. Over time, he developed the ability to spot profitable investments that others missed. Kiyosaki also learned the importance of cash flow and leverage. Rich Dad's investments were structured so that money worked to generate more money. Each asset had a purpose. Some provided steady income, others appreciated in value, and some created both. By observing and managing these assets, Robert understood how strategic use of capital builds wealth efficiently. Rich Dad emphasized learning from mistakes without fear. Every investment carried lessons, and even failures were valuable. Robert realized that fear of loss often stops people from taking action. By experiencing outcomes firsthand, he learned to balance caution with opportunity, turning knowledge into confidence. Another insight was thinking like a business owner, not just an investor. Managing investments meant understanding operations, finances, and strategy. The rich do not simply buy assets. They control them, optimize them, and align them with long-term goals. Observing his Rich Dad's methods taught Robert the mindset and discipline required to become a real investor. Finally, this chapter sets the foundation for understanding why the rich get richer. Learning on behalf of someone else is a stepping stone to independent decision-making. It builds skill, judgment, and confidence. Once you know how to think and act like an investor, wealth creation becomes intentional, strategic, and sustainable. The next chapter naturally follows. Why do rich people get richer? Where Kiyosaki explains the principles and strategies that allow wealth to grow continuously, even in uncertain markets. Chapter 19. Why do rich people get richer? Rich Dad often explained that wealth is not accidental. The rich get richer because they understand money, leverage, and opportunity in ways most people do not. Kiyosaki learned that their strategies, mindset, and habits distinguish them from the majority who remain dependent on jobs or traditional income. One of the main reasons the rich get richer is their focus on acquiring assets that generate cash flow. While most people work for a paycheck and spend it on liabilities, the wealthy purchase income-producing assets. Real estate, businesses, stocks, and intellectual property generate money continuously. Each asset multiplies wealth over time, creating a compounding effect that accelerates growth. Another reason is leveraging knowledge and skills. The rich invest time in financial education, learning tax strategies, market dynamics, and investment techniques. Knowledge reduces risk and increases returns. It also allows them to recognize opportunities that others overlook. While most people fear change or complexity, the wealthy see it as a chance to grow. Rich Dad emphasized using other people's money, time, and resources strategically. Investors borrow capital wisely, delegate tasks, and use systems to expand their capacity. This leverage allows them to control more assets and create larger income streams than would be possible relying solely on personal effort. Leverage multiplies wealth without requiring proportional work. Kiyosaki also learned the importance of thinking long-term. The rich do not focus on instant gratification or short-term gains. They consider how each decision affects cash flow, growth, and security over years or decades. Patience, persistence, and discipline allow assets to compound and opportunities to mature, producing far greater returns than rapid, impulsive actions. Another key factor is embracing calculated risk. While most people avoid risk, the rich understand how to manage it. They analyze investments, protect their capital, and make informed decisions. Risk is minimized by knowledge, preparation, and control. They do not gamble blindly. They make opportunity work for them. Rich Dad also highlighted the role of corporations and tax advantages. Wealthy individuals structure investments and businesses to legally reduce taxes and maximize growth. These strategies allow money to stay in the system longer, compounding faster, and creating a self-reinforcing cycle of wealth. Finally, Kiyosaki explains that the rich get richer because they focus on financial intelligence, not just income. They continually learn, adapt, and optimize. Their wealth grows from a combination of mindset, strategy, control, and continuous education. Unlike most people who rely solely on effort, the rich make money work for them, creating independent streams that grow regardless of their personal labor. This understanding sets the stage for the next chapter, A Lesson in Creating Money, where Kiyosaki explores the specific strategies, creativity, and financial thinking that allow the rich to generate new wealth and expand opportunities beyond traditional paths. Chapter 20. A Lesson in Creating Money. Rich Dad often emphasized that wealth is created, not found. Most people believe money is limited and must be earned through labor or inherited. Kiyosaki learned that the real investors understand how to create money through knowledge, innovation, and strategic action. The first principle of creating money is seeing opportunities where others see problems. While most people focus on challenges, the wealthy identify unmet needs, inefficiencies, or gaps in the market. By analyzing these areas, they find ways to generate value that translates directly into income. Money follows value, not effort alone. Rich Dad taught that financial education enables creation. Knowing accounting, cash flow management, tax strategies, and market principles empowers investors to structure deals, design businesses, and make smart investments. Without knowledge, attempts to create wealth are often risky and unsustainable. Education reduces uncertainty and magnifies results. Another lesson is leveraging creativity and innovation. The wealthy do not rely solely on existing opportunities. They invent products, services, or financial structures that others overlook. Kiyosaki notes that money is attracted to ideas that solve problems or create efficiency. By combining knowledge with creativity, investors generate new streams of wealth. Kiyosaki also explains the importance of taking calculated risks. While fear often prevents people from acting, the rich assess risk, develop strategies to mitigate it, and move decisively. Risk without knowledge is gambling. Risk with strategy and preparation is investment. The ability to act confidently is what separates creators of wealth from the majority who remain passive. Another key point is using leverage to expand impact. This includes leveraging money, other people's skills, time, and resources. By combining these elements, the wealthy multiply their capacity to create income without increasing personal effort proportionally. Each successful investment becomes a stepping stone to larger opportunities. Rich Dad emphasized that timing and vision are critical. Recognizing when to act and understanding the long-term potential of an investment determines success. The wealthy are patient, but ready to move when opportunities align with their knowledge, strategy, and goals. They balance action with foresight. Finally, Kiyosaki highlights confidence and persistence. Creating money is not always straightforward. Mistakes, setbacks, and learning curves are part of the process. Those who persist, adapt, and continue learning grow stronger and more capable of generating wealth over time. This lesson naturally connects to the next chapter. The Rich Invent Money, which explores how innovation, strategy, and financial intelligence allow the wealthy to generate opportunities and expand wealth continuously, often in ways that seem impossible to the untrained eye. Chapter 21. The Rich Invent Money. Rich Dad often told Robert that the wealthy do not wait for money to appear. They create it. Most people assume income comes only from a paycheck, inheritance, or investment returns. The rich, however, understand that money flows to those who invent solutions, spot opportunities, and take decisive action. Kiyosaki explains that inventing money begins with financial creativity. This is the ability to see beyond what exists, envision possibilities, and design structures that generate income. The rich do not passively react to markets. They shape them. They create businesses, develop products, negotiate deals, and structure investments in ways that maximize returns. Another lesson is understanding the power of leverage. Money alone rarely creates wealth. Knowledge, systems, and relationships amplify results. Rich Dad emphasized that by leveraging other people's skills, money, and time, the wealthy multiply opportunities. A single idea, combined with the right leverage, can produce exponential financial results. Kiyosaki also highlights taking calculated risks. Inventing money involves moving into uncharted territory, but the wealthy mitigate risk through preparation and knowledge. They analyze markets, evaluate cash flow potential, and structure agreements strategically. Risk becomes manageable when paired with insight and control. Rich Dad stressed that the mindset matters more than the capital. A person with limited funds, but a creative mind, can generate wealth far faster than someone with large savings, but no vision. The rich think in terms of possibilities, solutions, and systems rather than constraints or limitations. Another key principle is turning problems into opportunities. Where most people see obstacles, the rich see gaps in the market or inefficiencies to exploit. By addressing these needs, they generate value, and value is what attracts money. Every successful invention, business, or deal begins as a solution to a problem. Kiyosaki also learned the importance of speed and decisiveness. Opportunities are fleeting. The wealthy act quickly when they recognize a viable path. Hesitation often leads to missed chances. By combining knowledge, vision, and courage, they move from idea to action efficiently. Finally, inventing money requires continuous learning and adaptation. Markets evolve, regulations change, and technology shifts the landscape. The rich stay informed, anticipate trends, and adjust strategies. They understand that wealth is dynamic. It grows when nurtured and declines when ignored. This lesson naturally connects to the next chapter. A brief history of taxes and corporations, which explains how the wealthy structure money, assets, and income legally to maximize growth and minimize unnecessary losses. Understanding this framework is essential to sustaining long-term wealth. Chapter 22. A brief history of taxes and corporations. Rich Dad often told Robert that understanding taxes and corporations is a key difference between the wealthy and everyone else. While most people see taxes as unavoidable burdens, the rich view them as a system to leverage for growth. Corporations, legal structures, and financial rules are tools that can protect and expand wealth. Kiyosaki explains that historically, corporations were created to limit personal liability and organize business activities. Over time, governments recognized corporations as entities with separate legal status, allowing them to earn income, pay taxes, and take deductions differently than individuals. The rich learned to use these structures strategically. One important lesson is the difference between earned income and passive income. Employees earn wages and pay taxes immediately, often at higher rates. Corporations, on the other hand, can deduct expenses, reinvest profits, and defer taxes. This allows money to grow faster within the corporate structure, while legally reducing the tax burden. Rich Dad also emphasized the power of financial intelligence in navigating taxes. Knowledge of laws, deductions, and strategic planning can significantly affect outcomes. The wealthy hire professionals not to blindly manage money, but to apply financial strategies that align with their goals. Ignorance leaves most people paying more than necessary and missing opportunities. Kiyosaki learned that corporations also allow protection of assets. Personal assets are separated from business liabilities, reducing risk. This separation encourages the wealthy to take calculated risks without jeopardizing personal wealth. It also provides flexibility in structuring investments, partnerships, and transactions. Another key principle is using corporate structures to create wealth. Rich Dad explained that strategic corporations can generate multiple streams of income, manage cash flow efficiently, and provide leverage for further investments. Each legal structure, when used wisely, becomes a tool for multiplying money and controlling risk. Kiyosaki also highlights the mindset difference. While most people view taxes as something to fear, the wealthy see rules and systems as tools. They learn to operate within legal frameworks, optimize outcomes, and make money work for them, rather than letting taxes consume earnings. Finally, understanding taxes and corporations naturally leads to reducing risk through financial knowledge. The rich do not avoid taxes or laws. They use knowledge to make intelligent decisions, protect assets, and grow wealth responsibly. This foundation is essential for becoming financially independent and confident. The next chapter continues this lesson with a deeper focus on reducing risk through financial knowledge, showing how mastery over financial principles, rather than avoidance, ensures long-term success. Chapter 23: Reducing Risk Through Financial Knowledge. Rich Dad often reminded Robert that risk is not something to fear, it is something to manage. The key to reducing risk is financial knowledge. Most people avoid investment opportunities because they feel uncertain or unprepared. But the wealthy understand that knowledge turns uncertainty into opportunity. Kiyosaki explains that risk arises when people act without understanding. When you invest blindly or rely solely on advice without learning, mistakes are almost inevitable. Financial education, on the other hand, provides the tools to evaluate investments, anticipate challenges, and make informed decisions. Knowledge transforms risk from a threat into a manageable element of strategy. One principle is knowing your numbers. The rich study cash flow, expenses, market trends, and potential returns. They do not rely solely on intuition or luck. By understanding exactly how money moves in an investment, they can forecast outcomes and adjust strategies before problems occur. Awareness reduces mistakes and increases confidence. Rich Dad also emphasized diversifying knowledge as well as assets. It is not enough to learn one type of investment. Understanding multiple investment vehicles, business models, and financial tools provides perspective and flexibility. A well-informed investor can adapt to changing markets, recognize new opportunities, and avoid unnecessary risk. Another lesson is learning from others' successes and failures. Mentorship, observation, and case studies allow investors to see what works and what does not, without exposing themselves to the full consequences. Rich Dad encouraged Robert to watch carefully, ask questions, and apply lessons to his own financial decisions. This reduces trial and error mistakes and accelerates learning. Kiyosaki also highlights the importance of ongoing education. Risk is dynamic. Markets, regulations, and opportunities constantly change. The rich continuously improve their knowledge, staying ahead of trends, adapting strategies, and protecting their investments. Complacency increases risk, while continuous learning reduces it. Another key point is preparation and contingency planning. Knowledge alone is not enough. You must know how to respond if things go wrong. The wealthy create safety nets, structure deals carefully, and plan exit strategies. By preparing for worst-case scenarios, they reduce the likelihood of devastating losses. Finally, financial knowledge fosters confidence and control. When you understand how money works, how investments generate income, and how to mitigate risks, you can act decisively. Confidence reduces fear and allows you to take opportunities others miss. Mastery over risk through knowledge is a cornerstone of becoming a real investor. This chapter naturally connects to the next lesson, Financial Intelligence, the Key to Control, which explores how building a deep understanding of money, assets, and strategy allows investors to gain full control over their financial destiny. Chapter 24, Financial Intelligence, the Key to Control. Rich Dad taught Robert that financial intelligence is more important than income. Most people work hard, earn money, and hope that effort alone will secure their future. The real investors, however, understand that knowledge, skill, and strategy create control over money. Financial intelligence is what allows you to direct money rather than being directed by it. Kiyosaki explains that financial intelligence consists of several key elements. First is understanding accounting and cash flow. Knowing how money moves in and out of assets, businesses, and investments allows investors to make informed decisions. Without this knowledge, you cannot distinguish a profitable opportunity from a liability disguised as an asset. Second is investment knowledge. Understanding different types of investments, their risks, and potential returns allows investors to allocate resources wisely. The wealthy know how to compare options, identify growth potential, and structure deals that maximize cash flow while minimizing risk. Knowledge turns uncertainty into opportunity. Third is market awareness. The rich understand the economic environment, market cycles, and trends. They anticipate changes, prepare for downturns, and seize opportunities that arise during shifts. While most people react too late, the financially intelligent investor acts proactively, using information strategically to gain advantage. Another principle is tax and legal understanding. Financial intelligence includes knowing how to structure investments and businesses efficiently. Corporations, deductions, and legal protections are tools that reduce liability and increase returns. By mastering these strategies, the wealthy retain more of their earnings and reinvest intelligently. Kiyosaki emphasizes that financial intelligence is about control, not just knowledge. You can read about money, but until you apply concepts, analyze numbers, and make decisions, knowledge alone is ineffective. The rich use intelligence to gain control over assets, decisions, and outcomes. Control reduces risk and allows wealth to grow independently of personal effort. Rich Dad also highlighted continuous learning as essential. The financial world is dynamic. Regulations, technologies, and market conditions change constantly. Staying informed, adapting strategies, and refining skills ensures that your intelligence remains relevant and powerful. Without ongoing learning, even experienced investors can lose control. Finally, Kiyosaki notes that financial intelligence creates freedom. When you can understand, evaluate, and direct money, you are no longer dependent on a paycheck, job security, or luck. Control leads to confidence, and confidence allows you to act decisively. This mastery of money is what transforms a person from a worker into a real investor. This lesson connects directly to the next chapter, a lesson in financial literacy, where Kiyosaki shares practical exercises and concepts that deepen understanding, turning knowledge into actionable wealth-building skills. Chapter 25. A Lesson in Financial Literacy. Rich Dad emphasized that financial literacy is the foundation of wealth. Knowledge alone is not enough. To become a real investor, one must understand how money works, how to evaluate assets, and how to make decisions that generate income. Literacy in finance transforms ideas into action. Kiyosaki explains that financial literacy consists of three main components: understanding accounting, investing, and the market. Accounting knowledge allows you to read and interpret financial statements, cash flow, and balance sheets. Without this, even profitable ventures can appear confusing or risky. The wealthy use these tools to make accurate assessments of potential investments. Investment knowledge is the second pillar. Understanding different types of assets and liabilities enables investors to allocate resources wisely. Real estate, stocks, businesses, and intellectual property all carry different risks and benefits. Financial literacy equips investors to identify opportunities that fit their goals and strategy, while avoiding traps that can drain capital. The third pillar is market literacy. The rich observe trends, cycles, and economic shifts. They anticipate changes, recognize opportunities, and act when others hesitate. Financially literate investors make proactive decisions, using information to increase advantage rather than reacting passively. Rich Dad also stressed the importance of practical application. Financial literacy is not just theory. It is about applying knowledge to real situations. Robert learned to analyze deals, calculate potential returns, and structure investments for maximum advantage. He saw that literacy combined with action creates results. Another lesson is understanding the difference between assets and liabilities. Most people confuse income with wealth. Financial literacy teaches that assets generate cash flow, while liabilities consume it. By focusing on acquiring assets and minimizing liabilities, the wealthy grow their financial independence. Kiyosaki highlights the power of continuous learning. The financial world evolves, and literacy requires constant updating. Understanding tax strategies, corporate structures, and investment vehicles allows investors to adapt and thrive. Those who stop learning are vulnerable. Those who continue learning build lasting wealth. Finally, financial literacy fosters confidence and control. The ability to evaluate, decide, and act on investments reduces fear and increases opportunities. The financially literate investor is empowered to create wealth strategically and sustainably. This chapter sets the stage for the next lesson: the ultimate investor, where Kiyosaki combines all the principles learned to describe what it truly means to master investing, achieve financial freedom, and think like the rich. Chapter 26: The Ultimate Investor. Rich Dad often described the ultimate investor as someone who understands money, controls risk, and creates wealth strategically. Unlike ordinary investors who react to trends or work solely for a paycheck, the ultimate investor acts intentionally, using knowledge, systems, and foresight to build lasting financial independence. Kiyosaki explains that the ultimate investor combines financial intelligence, creativity, and courage. Knowledge alone is not sufficient. Investors must analyze opportunities, design strategies, and execute decisions confidently. Courage is essential because all investments carry some level of uncertainty, and hesitation often leads to missed chances. One key principle is mastering cash flow. The ultimate investor focuses on assets that generate consistent income while minimizing liabilities. Cash flow is the lifeblood of wealth, providing freedom, security, and the ability to reinvest. Understanding, tracking, and managing cash flow allows the investor to make calculated moves and respond to market changes. Another element is leveraging knowledge, money, and systems. The ultimate investor uses not only personal capital, but also resources such as other people's money, skills, and networks. Leverage amplifies impact, allowing small investments to grow exponentially when combined with strategy and management. Kiyosaki also emphasizes innovation and problem solving. The ultimate investor creates opportunities rather than waiting for them to appear. They see solutions where others see obstacles. Money is attracted to value, and value is created through vision, effort, and strategic thinking. Inventing money is a habit, not a one-time act. Risk management is another critical factor. The ultimate investor does not avoid risk. Instead, they control and mitigate it through knowledge. By understanding investments, markets, and legal structures, they reduce uncertainty and increase the likelihood of success. Every decision is calculated, and losses become lessons for future improvement. Rich Dad highlighted long-term thinking as essential. While others seek quick gains or temporary security, the ultimate investor plans decades ahead. They prioritize sustainable growth, continuous learning, and disciplined action. Patience and foresight transform short-term setbacks into long-term advantages. Finally, the ultimate investor combines all lessons from Part 1 and Part 2. Mindset, education, strategy, creativity, and financial control. They no longer work for money, they do not rely solely on saving, and they use knowledge to generate, grow, and protect wealth. They think, act, and live differently, and that difference is what separates the rich from everyone else. This chapter naturally concludes the journey of becoming a real investor. It connects all previous principles and prepares the reader for action. Applying knowledge, creating assets, and thinking like the rich in everyday life. You've just unlocked the secrets of Rich Dad's Guide to Investing. Now you know how the rich think, how they create money, and how they turn knowledge into unstoppable power. This is your roadmap to financial freedom, and it starts right here. But knowledge alone isn't enough. The real transformation happens when you take action. Apply these lessons, invest smartly, and watch your financial world change forever. If you want more mind-blowing strategies and secrets to build real wealth, hit that subscribe button now and join our growing community. And here's something new. Use YouTube's hype feature to boost this video. Show your support, help this content reach more viewers, and be part of the journey that turns knowledge into power. The more hype, the bigger the impact. Don't just watch, take control, take action, and start thinking like the rich today. Subscribe, hype, and start your journey toward financial mastery. Your future self will thank you.